the start of another week in the new year, and let's get into some very important conversations around Nigeria's economy. Now, the International Monetary Fund's country representative for Nigeria, Dr. Christine Ebeke, reveals that Nigeria's economy faced a risk of regressing should economic policies initiated by the current administration be reversed. He noted that the progress resulting from the policies has yet to reach its potential, notwithstanding some of the recorded economic gains, such as the reduction in the current inflation rate. As a result of this, IMF representative urged that the present administration also to stay focused in implementing the reforms and policies initiated a couple of years back. He explained that the state government's inclination for pro-cyclical spending, particularly in run-up to elections, might undo the progress made by our Nigerian government. Now, on the fiscal front, we see that the president has advocated for comprehensive tax reforms, which is aimed at increasing revenue, broadening the tax base. The administration of President Bola Tinubu has aimed to simplify Nigeria's fragmented tax structure, improve compliance using digital tools, and reduce the country's over-reliance on all earnings. Well, I'm starting my week today with my guest. Is Mr. Robert Omotunde. He is a director, chief investment officer, MDU Capital Investment. Well, he's live in the studio today, not joining virtually. Good afternoon, and it's really good to have you in. I think this is the first time having you in the studio. I'm talking this year.
Oh, yes.
Happy New Year.
Happy New Year to you.
Good to see you.
Good afternoon.
Thank you so much for coming through.
Yes.
I think we should start off with inflation, which we saw sometime last week. At the end of the day, 15.15%, thereabout that. Yeah. We wrapped up the year with the base effect and all of the components of these figures. Can you help us unpack what you make of this? Because I must tell you, many analysts, and even me as a journalist in the business environment, was expecting something higher.
Absolutely. So, I mean, what has happened with the reported inflation figure, reflected the change in methodology of the NBS, that's National Bureau of Statistics. Yeah. And you will recall that, I mean, since the data was announced earlier in the first quarter of 2025, we saw consistent deceleration, right, in the level of inflation, right, up until November, when we saw the figure at 14% levels. So what we expected was perhaps a slight further deceleration, or maybe even if there was going to be an uptick, something not higher than 15%. Of course, the government targeted to have inflation at 15%, so which was already being celebrated that, government has achieved that objective. But then we saw the change methodology by the National Bureau of Statistics, who in its wisdom decided to also change it in line with best practice, and that's the best we can pick from there. And that is now showing that November inflation, which was previously reported at 14% levels, should in fact have been should have printed at around 17%. And then the current inflation December figure, at 15.15%. I think the point is that, for analysts, a lot of us come into the studio and then to analyze numbers, as reported by the authority. Yeah. That is, for instance, there is I don't know of anybody in the country that has the capacity of the government, to report accurate inflation figure because of the activities involved if you were to embark on that journey yourself. And I would say government, if you check the methodology of National Bureau of Statistics, they have representative in every major market in Nigeria. They have full soldiers who will report this data from the market on a monthly basis. In fact, by far, I think they take those numbers up to 2 or 3 times in a month before arriving at what the figure is. But again, the MBS is not saying that the reported figures have changed. What they are saying is that there's been a change in the methodology where they're now having to use the average of the base year, 2024, rather than one data point. I think the best we can do is to take it as the MBS has reported it, because the other alternative is for you to go try and embark on one by yourself, which of course may not be as credible as what the MBS will report. Now, if you analyze that number from 17 to 15% level, then that would mean that you had some marked improvement, right? If we were to take the 17% levels to be accurate. But then when you compare that with the Utah season that was, majorly in the air in December, it will show a reversal of the usual trend. But then, of course, we have to look at the number with so much caution. The caution in this sense will be that, there's been a lot of technical changes in the computation. Yes, and that technical changes cannot be dissociated from that, moderation in headline inflation that we saw. So again, you cannot just pick the figure and analyze it without looking at that rebasing exercise and all of its complexities that we began to, that we now saw. Hopefully, this will be the end to it. I think the MBS has been able to get his methodology right, and then we should continue on that pace, because we don't want to send a signal to the market that the numbers are not that reliable. I heard somebody saying, are we going to see another change, and another change? So, that shouldn't be the case. Now that the MBS has already readjusted the so-called methodology, hopefully we can then begin to have, a normal reporting, so that, of course, because these things have implications.
They do.
Right? I'm in the investment space.
Decisions,
one of the implications of a moderated inflation in 2025 that we saw was that the yield in the fixed income market moderated significantly. And I must say, when we opened the year, yields were as high as 22% levels, right? In fact, the federal government, through the Debt Management Office, issued an instrument that was 22.6%. Today, that instrument is a juicy instrument in the market, because then yields have now moderated to about 17% levels. But then imagine now that we are now beginning to hear that inflation is about to tick up again. The implication is that yields will begin to rise again. So there are monetary consequences for all of this data, and I'm just using my own space to analyze it. So there are financial consequences actually to when data is reported and then is adjusted and is changed. And again, for instance, one of the results of this is that I will expect uptick. For instance, if we think that yields will begin to tick up again, in the fixed income market, then repricing is inevitable. So government must take more caution to ensure that we are clear about our methodology before we put them out there, because they have consequences for businesses.
Indeed, and the NBS would always tell you that before they come up with decisions, they meet with their stakeholders, the likes of the World Bank, IMF, because they don't take some of these decisions alone. But let's take a step back to the reforms that brought us to this point. Now, 15.15%. That's what we wrapped up 2025 with eventually. Now we are moving into 2026, where everyone is expecting that there should be an easing, particularly with regards to rates. That first meeting that would happen in February, there's been a lot of conversations around that. Now, what are your concerns? IMF says no going back on these reforms. The people, the players in the rail sector are telling you, we cannot borrow. This is getting too much for us to manage. So how do we balance all of this as we move towards expectations from, of course, the economic players?
Yeah, I think that's a very good way to look at it from, which borders on what I said earlier, that the implications of all of these numbers is how they affect the policy, leaning of the government. And, I don't think that anybody will go against IMF at this point, advising the government to stick to those policy changes that we have seen.
Considering the results we've seen so far.
If you look at 2025, in fact, let's go back to 2024, where we were coming from, and looking into 2025, we had much difference, in terms of stability in our foreign exchange rate, in terms of moderation in in interest rate, also moderation in inflation rate, even though we will argue that, of course, the rebasing exercise played a role in that. So then to go back, when we talk about policy reversal, let's be clear on what we are saying. It was later, towards the end of 2024, that it became clear that policy has, subsidy is already gone. Subsidy on petroleum products is out of the way. Subsidy on electricity is out of the way. Foreign exchange market will now be more market reflective. Now, these are very good policies that the government has put out there that has their implication on the common man, as we would normally say. But then, the alternative is no-go area for the government either. You know, you don't want to get back to the point where subsidy is now reintroduced, because the consequence of that is that government is not even fiscally viable enough to be able to fund subsidy. I mean, government is able to do all of the things that we are able to do, some critical infrastructure. You know, in 2025, you know, we saw significant progress in the coastline, road that the government embarked upon, and so many other critical infrastructure projects. Now, to roll back all of those is, you know, going back to the doom days. You know, I mean, and I don't think that anybody who loves the country, you know, will say that the government should. And besides, I think this government is very tough on policy. And, you know, once the government is clear on which policy directions it wants to go, you know, I'm not sure that it can be easily talked out of it. But then the point then is to say, how do you then balance it, you know, together with all of the changes happening within the economy? You know, I mean, your question is trying to look at government rolling, can government consider rolling it back, you know, in light of some of the, you know, outcry from the, you know, manufacturing association and the likes of it. But then the point is that on interest rates, you know, you will notice that most of what we have seen in terms of policy readjustment, with the exception of exchange rate, has been on the fiscal side, right? On the monetary policy side, what has been happening is that the central bank is trying as much as possible to maintain this tight monetary policy in order to ensure that the quick gains that have been seen are not rolled back. You know, because if you think about it now, we still have policy rates in excess, you know, of 20%, you know, much in excess of 20%. Meanwhile, you have a policy, you have a market rate already below 20% levels, you know, if you are looking at bonds and treasury bills, of course, you know, but then maybe slightly above 20% for treasury bills in terms of yield. But then when, you know, we look at the rate of borrowing at the banks, right, because it's also tracking the MPR is much higher. You know, you have MPR at around 25% levels. It's not very easy for, you know, because the banks will always price around that level. So what I think the Monetary Policy Authority can begin to do is, once we are clear on the direction that inflation is going, and we are clear on, you know, if there will not be new pressure points, especially because of 2026, that is a pre-election year, then we can begin to bring the yields a bit downward. I mean, the interest rate, talking about the monetary policy rate now, bring it a bit downward, just to ensure that lending rates, again, can adjust almost symmetrically to the adjustment that is done to interest rate. Because once you're able to achieve that, for instance now, you know, MPR at, you know, at the level...
Yeah, at the 27%,
yes,
right?
Yes, at the level that it is now. For you to bring down, you know, MPR to the level where the market rate is right now, you know, the MPC will have to be doing a lot. You know, you are reducing interest rate at not less than 500 basis points, at least to try to catch up with what, you know, the market rate is now. And again, MPR is an anchor rate anyways. The idea of having the monetary policy rate is to anchor other interest rates within the economy. Now, since the market, you know, talking about the treasury market now, is within that, you know, 18 to 22%, you know, well, of course, the exception is OMO rate, of course, which is not meant to be accessible to non-banks and, you know, other players within the market. Then we can begin to have, you know, a much more lower interest rate for manufacturers to borrow. So the call here is that MPR can be reduced without necessarily impacting on the level of inflation in the country, because again, we've had some gains. You don't want those gains to be rolled back. So definitely the MPC can still consider some of those adjustments within that corridor. But I understand the fears, which is that we're coming from a 30% level, even though it was before the rebasing exercise. You know, that the rebasing exercise has, you know, led to much gains that you have seen. You don't want to loosen too quickly and then see that you have some pressures in your hand to deal with. But I'm sure that once the coast is clearer, and we are sure that, because think about it, other pressure points like pump price of petrol, we've even seen some moderation in the pump price of petrol. And we are no longer seeing aggravation coming from exchange rate increases. So with those moderation, you know, we should expect that, inflation will gradually decelerate, and then as that is happening, it will give the MPC more confidence to bring down interest rate, and then which will ultimately affect the borrowing rate or the lending rate from the perspective of the banks. But definitely, I think this is not the time to begin to celebrate or to throw parties and then ease, only for you to find out that you still have much to deal with. So I think that the caution that the central bank is still taking is still the best way to look at it this time.
Interesting stuff. Now, almost finally, we've seen developments in the banking space. We've seen developments in the insurance space.
Absolutely.
Now we are seeing developments also in the stock market space.
Oh, yes.
Where we are almost like a recapitalization proposal
Absolutely.
already on ground.
Absolutely.
I want to ask you specifically what this means for operators, of course, in the market. Some are already having, their mindset regards to this, saying this might also affect the market adversely. Some say they need more time. This might affect investor confidence and all of it. So, but tell us how it comes to you.
I think that this all ties to the efforts of the government to get the economy to about $1 trillion. Right?
Yeah. That's the aim. That's where we are headed. That's $1 trillion economy.
And see, there's something we call financial intermediation, right?
Yeah.
Intermediation is what the banks majorly are known for, right? In fact, all the financial services sectors or subsectors of the economy, that's what they are known for. Talk about the banks, talk about the insurance, talk about the capital market. And you did mention it. We've had the capitalization in the banking sector, in the insurance sector.
Yes.
The latest in town now is in the capital market.
We have to join that train.
Oh yeah, we have to join that train. And I mean, all of the efforts of government is to ensure that for a $1 trillion economy to be powered, you need a solid financial service sector. That's the way it is. In fact, in an economy, there are only two broad sectors in an economy. You have the financial sector and you have the real sector. The real sector is going to leverage on the ingeniousness or the capital available within the financial sector in order to grow. And the real sector will ultimately drive the economy, but then you need the financial service sector to support it. And now we've done that successfully, we're still about finalizing it in the banking sector and in the insurance sector. But then the capital market cannot be a laggard. And that's what is happening where Securities and Exchange Commission is asking, capital market operators, including the core, areas of regulation and the non-core areas to recapitalize. And this recapitalization is also a bold step because you're seeing, the increase is happening by more than 10 times. For instance, portfolio managers or fund managers that were formerly capitalized at about 150 million and has to recapitalize to, in fact, they have different tiers. Tier 1, will recapitalize to about 5 billion, right? Where tier 2 is expected to recapitalize to about 20 billion. I mean, at the minimum, you expect that recapitalization is not, you are doing up to 13 times, if you are a tier 2. And if you are a tier 1, the multiple is closer to about 40 times, in terms of recapitalization.
Yeah.
Now, it might be tough for operators to be able to quickly meet up with this. But then ultimately, one of the things that has been happening, especially with Securities and Exchange Commission, is a continuous engagement with the market, the stakeholders. They will listen. Even before this news came out, a lot of operators were already expecting it because we've been having sound bites of, a possible recapitalization exercise. And of course, engagement is still ongoing, and I know that at the end of the day, there will be a level that is both not stifling to the sector and ultimately helps to grow the sector much better. But definitely, this is not an unwelcome development happening in the capital market. It is expected because, of course, if you look at the size of funds that are also managed within the overall capital market, it is expected that you need some levers in terms of capital buffers so that you can also be able to do much more. I mean, what it does for you is, most times capital market operators will be judged by the amount of capital they have relative to the assets that they manage. So if you manage bigger balance sheet in terms of your asset under management, it is expected also that you should have sufficient capital buffers, to cater to it. And I think that is what the Securities and Exchange Commission is doing. Ultimately, what is happening in the financial service sector between the banks, the insurance, the capital market, we ultimately work together for what the objective of the government is, which is to get the country into a $1 trillion GDP. though it looks like we are still far away.
A lot of work still needs
from
to
that
be done.
level.
But let's
Yes.
wrap up now. What will be your outlook? You know, I always like to have those projections,
Yes, please.
particularly it's a new year. We need to have, should we say, in the short term, medium, and long term, if we could just hit that up in like 2-3 minutes.
Okay, so I mean, when you look at the overall space,
Yes.
right? I think there's
so many beautiful pictures.
No.
Everyone is saying
I see that.
it's looking good.
I
it's
see that.
looking
But then,
good.
you know, in 2025, we saw a lot of changes, you know, that impacted positively on the economy, right? And I will not take that away very quickly. You know, the stability in the exchange rate foreign exchange market, you know, is that which we must continue to sustain.
Honestly.
You know, and I think that the central bank will stop at nothing to ensure that they keep the pace, right, and to ensure that the whole stability that we have enjoyed, we don't lose it very quickly. You know, inflation, which is what is in the lips of everybody, you know, is one thing that they have also been able to do successfully, which I think they will keep. But then we must prepare, because we are looking into 2027, you know, and I mean, there is nobody that doesn't know already that the electioneering campaign somewhat has already started.
Yeah.
You know, in fact, some people believe that whatever calculations was done in 2025, 2026 will just be seeing, you know, the release of all of those calculations come into play. And this is when the government tend to want to impress a lot, because elections are coming in 2027. I just hope that as we do that, we are not losing sight of all the positives that we have seen in 2025. But in terms of outlook, I think that we are still in a recovery mode from all of the issues that we have had over the past, I would say, 10 years, you know, since the administration of the previous government, before this current government. So we are still in a recovery mode. So, and I don't expect that 2025 will be that year where, you know, everything will now begin to blossom again. There may still be some, you know, pains to bear, you know, for 2026, you know, such that as we go into 2027, if elections don't, you know, debar some of those progress, then we now begin to see the benefit of some of these reforms that we have put in place. But going back away from these reforms is not option. It's not option.
Not
at
an
all.
option at all.
It's
not an option. I believe so. It's not an option
it's
too.
not an
I
option.
agree with you.
Yes.
We've gone through that pain, so let's just get the game.
Let's get it.
All right, then. Mr. Robert Omotunde, interesting starting the week with you as always.
Thank you.
Director, Chief Investment Officer, MDU Capital Investment. And again, congratulations on your new role.
Thank you very much.
All the
Thank
best.
You. Thank you.
Cheers.
Thank you.